Today's video is sponsored by the Great Courses Plus. What's up, guys? Welcome back to the Easily Profit YouTube channel. Now in today's video, I really want to show you guys some highlights from a swing trading lesson that I did. There's going to be a lot of big concepts and especially a lot of strategy here that I really want to show so everybody can really benefit from it. Especially the session usually lasts around an hour, hour and a half, but I kind of condensed it down into a lot of the big points here. So hopefully you guys enjoy this and especially get a lot of added content and some good strategies out of this. Hope you guys enjoy. What you're going to find is the best swings are going to be in the same price range and same volume range. So it's not that I want to tweak these filters that I use. So I still look for small cap stocks, which are typically just going to be lower price stocks that have the ability to move in percentage fairly quickly. Now, depending on the time frame, remember, if it gains 5% per day, that is still quick in the overall picture of especially the stock market. So it's still a quick form of trading and investing. But I look for the same price range, and then volume. Volume isn't going to be too specific where I say, okay, you want to have a scanning minimum of 200,000, but you don't want to buy stocks less than $1 million. So typically I will use my watch list of having the top 4 stocks above $1 million. I don't kind of follow those rules. If they're over 200,000 volume for the day, that's kind of fine with me. So especially on the short side, the next filter that I'm going to be using is going to be a study filter. So with study filters are going to look for certain occurrences, patterns. It's just much more in depth than a normal scan filter. So the study filter that I use is I look for stocks that have price performance and look for near highs and lows. So this is where it gets a little bit more in depth here. And typically what I look for with a swing is I look for stocks within 3% of the 252 period high of the day. So this string of words, all this means is I'm looking for stocks within 3% of the yearly high. There's 252 trading days per year. And if I'm looking for the 252 period high for the day, that pretty much is synonymous with the yearly high, 52-week high, same thing. And if stocks are within 3% of this range, it means every stock that pops up here on my scanners now are all going to be either near, at, or above their yearly highs. So typically a yearly high, a 52-week high break is a very, very strong bullish move. It means the stock is setting new highs. Typically some companies want to capitalize on that. They'll send out PR and press releases. And they'll say, hey, we're innovating in the sector. We're at its yearly highs, blah, 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 and gains a lot more. They're just kind of playing off of the sentiment that's going on. So if you look at every single play that pops up here, and if I go to the daily chart and every single one of them, every one of these stocks are pretty much running either near their highest points for the year or either are breaking past those highest points. So these are a lot of bullish sentiment trades. So some people look for the 52-week lows. So they look for the lowest points the stock have reached during the year to look to dip buy them or buy them at a very, very low point in the year, and typically look to hold them and look to sell them for a new high that may potentially develop later. The problem with buying the 52-week lows and the lowest points that the stocks are reaching during the year,
they tend to be downtrends.
Exactly. If a stock is in a downtrend, if a stock is at a 52-week low, that doesn't mean the stock is in a very, very good position. So what's to say that it's not going to keep on going even lower than that? It would suck to dip buy the stock in the 220s and it keeps on going to 2 and it breaks below 2 and goes to the 190s. That happens all the time. So
I can only see this working if you have a filter for large market caps.
Exactly. The larger market caps, a lot of those companies can recover from usually being at 52-week lows. Like if Apple is at 52-week lows, that's probably the best time to buy. Not necessarily these OTC and penny like I guess the small cap trades on the NASDAQ and some of the OTC stocks here, because typically if a small cap trade, which is small cap for a reason, it's not a huge company, and they're at their lowest points, it's kind of, it's pretty much a nail in the grave at that point. So with a lot of these plays, I typically just go after the highs. Now, for the specific positions you want to take on swings, you're using a lot of the sentiment that you will keep in the dailies, like in normal day trading, but you're applying them to a longer time frame. So breakout points, psychological points, resistance levels, all these are going to carry over, but you're looking at the trade in a much simpler and much shorter time frame. So if we look at a stock like, let's say, CGEN. So if I'm looking at CGEN here, typically with swings, you have enough time to research the stock, see what they're doing, earnings per share, float. It's not like you have to cram your position within 1 or 2 minutes. Sometimes window of opportunities for entries may last hours or sometimes days. So I find that if a stock is heading towards a yearly high and you want to play the break of it, sometimes it can be at a very good opportune time when you have enough time to actually look to play the break. So typically we have a solid level of resistance that previously has been set. So 431 here is technically the 52-week high for the stock here. So I'm going to set a line all the way across. And typically with most of my swings, what I like to do is I'd rather cheat, and then I'll just right click, hit create an alert, and I'll create an alert if the stock is at or above 430. So if I have it where the last is at or above 430, whenever the 430 is touched, the stock is going to send me the platform is going to send me an alert. I have it linked to my phone, so send me a text message. Hey, CGen is breaking out of 430. What do you want to do? I can open up the platform, especially look at the stock, remember all the research that I've done, and either look to choose a position if I can see a confirmation of a break above a certain breakout point of the stock here. Now, typically in fashion, whenever you're looking at potential swings to take on the top side, you're just looking for a breakout over a certain resistance level. Now, resistance levels will be key in a lot of these trades here, where you have to know where other resistances are lying in between the mix. So a lot of times, let's say if you have a breakout point of 430, typically if the stock wants to swing even higher, probably the first place it may get stuffed maybe around the $5 per share level. That's the next level of psychological.
Why not 4.5?
Well, see, like 450, I find in the higher prices, they don't like to follow the 50 cent per share ranges. A lot of times, once you get past 3, it goes from 3 to 4, 4 to 5, 5, 6, 7,
Okay.
8, 9. Whenever you're in like the 1, sometimes it can go 1, 120, 140, 160, 180, 2, 250, 3, 350, and 4, 5, 6, and past that, it keeps on going all the way up. But that's kind of the strongest ones. And that may be slight selling pressure at those 450s. It will never be perfectly it'll just perfectly glide through that level. Typically at like 450, there is going to be a little bit of selling pressure that may develop from there. But typically what you don't want to have is you don't want to have a 52-week high break point, let's say at 491. So if you have a 52-week high break at 491 and you play the break, what is the next level it can potentially get stuffed at? At $5 per share, which is a psychological point. So if you measure between two resistance points, you're going to have that inherent amount of like potential profit. So from 491 to 5 is only 9 cents per share. I have 9 cents per share of room before I'm hitting the next level of resistance. Rather than playing the break of 491, you should just wait for the break of 5. If it can truly break 5, it has the ability to probably go to 550 and 6. So you kind of want to play your best foot forward in a lot of these situations. Don't set yourself up to really take entry that has a resistance level right there at that point. Now, what I like to do is on all trades, on all swings that I potentially look to jump into, I like to keep a reference of all the psychological points. And you can see that if you start drawing psychological points on your chart, you can see how you can see how stocks just like to react to those. Almost just it gets kind of scary as you look at the trades. So especially like as this stock is spiking up and as it breaks above, let's say from 5 to 6, you can see a very nice progression for 3 days until it touches the top of 6, to around 7, pulls back to 6, carries above that, almost gets to around 8, then it really kind of throws in the towel at this point. So you can kind of see these very gradual breaks, pulls back to support, takeoffs, pullbacks to support, takeoff. That's why I always like to buy on the pullback to support, because either it wants to break down very quickly, and then I have my maintained risk that I'm going to be jumping to the trade. Sometimes you're going to end up falsely getting tripped out. That's why you have your stop losses set and a nice little risk level. Most of the time, you're going to grab it at a very good point. You're able to buy it near the nearest level of support and take it on the next run up. I just don't like, this is what most people do. Most people see the stock heading to a level of resistance and they want to buy here. I don't want to buy here. I want to buy once the stock pulls back and it pulls back to the nearest level of support. This is where you want to buy on the bottom side. But if you look at this stock from its past, it's still a bullish move. So I'm not just dip buying any stock that has gapped up overnight and is starting to downtrend and will dip buy a downtrend. Like, no, you're not supposed to do that. You're going to dip buy an uptrend that is developing on the stock. Another thing that I would use on swings, and I find that I more accustomed to using on swings is going to be indicators. So for me, indicators are going to be a bigger help than on the day trading side. You find in the intraday on most stocks, indicators are just going to go wild because each indicators base themselves off of candlesticks. So you're just going to find that you have all these candlesticks spiking, pulling back, pre-market gap ups, whatever. Some of these indicators are just going wild. So the main indicator I use for my swing side is going to be moving averages, and more specifically, exponential moving averages. So I find the exponential moving averages are a good line for me to look for sentiment as a stock is rising during the day. You typically have this notion, what we usually call ride the nine EMA. So with EMAs, typically if a stock is above an EMA, it's seen as it's in a more bullish mode. And as long as a stock stays above an EMA, it will consistently be profitable. Same thing on the bottom side. As long as the stock is below an EMA, it will keep on downtrending. And typically, if you're looking to short a stock, you want to short the EMA as well. And now the crossover points for EMA, whenever it goes from being bullish to bearish, typically are going to be levels of support or levels of resistance. So if we look at the stock as it's spiking, quickly gets out of range of the EMA, it pulls back to the EMA, trends on the EMA, spikes up. You can see that. Now, points where it crosses below and goes much below, typically that's going to be an area where you possibly should look to get out. It may not be as detrimental early on in a swing. Well, early and late is all relative to what how developed the chart is. But especially at a point like this, where you can see that once the stock fully crosses below the EMA, now the stock pulls back, and now the EMA is like a level of resistance. So you can find that extreme moves above, typically the EMA becomes support. Extreme moves below, typically the EMA becomes resistance. So I find it as a good guiding principle that if I'm looking to buy a swing, I don't want to buy a swing below the EMA on the daily. I'm typically looking to buy the swing above the EMA. So let's say if you're looking to buy, let's say as the stock breaks and it's starting, and for example, pulls back and you're looking to buy the dip, I'm not going to be buying the dip below, let's say, 614. So if the stock is dipping down and I see it's in the 607, 609, 590s, I'm not looking to buy the stock. This stops you from inherently buying the dip on a stock that will continue to downtrend. I find that if I end up buying on the upside of the EMA, let's say as it starts to come back up, and now it's past 618, now I have the green light to potentially dip buy this trade. It makes much more sense to do that than to not have this line on, because a lot of times you don't really know where that non-EMA line is really supposed to be. And you can end up dip buying a stock that really has the potential to keep on going down. So especially rather than dip buying past this certain point or whatever like this, especially people will look at this, oh, it's a big, large dip, time to dip buy it. It's much below the EMA. That's not a very, very smart thing to do. So I just like to use these indicators at the end of the day. Another one that I may use here and there is like RSI, Relative Strength Index. Most of my indicators are helpful. Now, some people want the indicator that is just going to be, okay, buy or sell indicators. Most, if the majority of indicators are going to be lagging indicators. They're not going to predict anything. They're pretty much going to tell you what you already see, but you need to use them as a guiding principle to keep your own self consistent. It's like a spell check for your own FOMO or your own tendencies to buy early or buy a little bit too late. So I find you need to use. Yeah, go ahead.
So you're still gonna rely mostly on reading the price action, and
exactly
10%. These probably contribute like what, 10-20% of your decision making?
Yeah. It's a very, very low margin. I just want to make sure that if I'm buying a stock, it's above that point in. And especially if I'm looking at a stock and I potentially want to buy into it, and I look at the RSI, let's say if I'm looking to buy on the dip, especially near the level of around 6, which I did last time, it's much below that 70 percentile on the RSI. When stocks are heavy above the RSI, especially above 70%, they're kind of seen as being overbought. So typically at this overbought level, if it's above 70%, it's due for a pullback. That doesn't mean it can't keep on running up for the next, the next 2 or 3 days or so. But typically if you go back below the overbought 70 percentile level, and then you see a buy signal happening below this point, I know I still have room of growth until I hit that overbought level. So it's things like that just help you to just better see the trade rather than just looking at candlesticks. Now you're seeing other little metrics that potentially work. Now I'm never saying okay, you want to short sell a stock that's above the RSI and buy a stock that is way below the RSI. No, if you use buying signals and selling signals like that, you're consistently going to lose, because if there's a perfect indicator, there's no reason to trade anymore. I mean, all you got to do is just set a computer and a bot to just buy and sell based on these metrics, ones and zeros, and you'll be a billionaire. And it just doesn't work at the end of the day. So it still is always going to be leveraged on your ability to analyze the stock, analyze the price action, and look for very, very opportune movements, which I always find is in bullish sentiment, breaking past psychological points, retracements to support, making sure they're still above the RSI. Once you see that move starting to head to the upwards direction, usually you can play it for the next 2 to 3 days, looking for around a 5 to 10% profit, like around 5 to 6. If you want to squeeze it to 10%, you can look for that. The Great Courses Plus is a subscription on-demand video learning service with top-notch lectures and courses from top professors from the Ivy League and other great universities globally, and experts from places like the National Geographic, the Smithsonian, and the Culinary Institute of America. With the Great Courses Plus, you get unlimited access to a huge library of over 11,000 video lectures about anything that interests you: science, math, history, literature, or even how to cook, play chess, or become a better photographer. I've personally been enjoying the Critical Business Skills for Success course. They have a section where you learn how to value a company's stock. This will come in handy, especially in trading, where you know if you're overbuying a certain position or especially undervaluing a certain position. So the Great Courses Plus is giving all viewers a free trial of their service. Show your support by subscribing to the Great Courses Plus. You can go to greatcoursesplus.com/eat sleep profit. Click the link in the description below to start your free trial today.